Hello everyone, I'm Aaron Blake. Gold prices have just suffered a sharp and sudden drop, tumbling more than 8% in a single session and briefly breaking below the critical $5,000 level. This move comes at a moment of heightened investor caution, just ahead of a key U.S. Federal Reserve leadership decision, and it has sent shockwaves through precious metal markets worldwide. What's happening right now is not just about gold dipping on a chart. It reflects a powerful shift in sentiment, currency strength, and investor behavior that is unfolding in real time. Before we go further, subscribe right now, because what you're about to hear explains a shift most people still haven't noticed. Let me walk you through exactly what happened, step by step, and why markets are reacting the way they are. On January 30th, gold prices fell sharply, recording a decline of more than 8% during the session. At their lowest point, prices briefly slipped below the psychologically significant $5,000 mark per ounce. This move occurred as the U.S. dollar strengthened, and investors turned cautious ahead of an important announcement regarding the leadership of the U.S. Federal Reserve. Spot gold was down 5.7% at $5,087.99 an ounce by 12:57 GMT. Earlier in the same session, it had dropped as low as $4,957.54. At the same time, U.S. gold futures for February delivery were down 4.6%, trading at $5,081.70. These are large moves by any standard, especially in a market that had recently been trading at record highs. This decline followed an exceptionally strong rally. Just one day earlier, on Thursday, gold had surged to a record peak of $5,594.82 an ounce. Despite the sudden pullback, gold remains on track for a gain of more than 17% for the month, which would mark its biggest monthly increase since 1982. It would also represent a sixth consecutive monthly gain, underscoring just how powerful the broader uptrend has been. What stands out here is the speed and scale of the reversal. According to Rania Gul, a senior market analyst at XS.com, the decline appears to be a strong correction driven by profit-taking after the rapid rally. She explained that the swift rise in prices prompted many investors and institutions to reassess their positions and reduce their risk exposure. In other words, after prices climbed so quickly, market participants began locking in profits, leading to a sharp pullback. This development comes as the U.S. dollar held firm following a major political and economic announcement. President Donald Trump selected former Federal Reserve Governor Kevin Warsh to lead the U.S. Central Bank when Jerome Powell's term ends in May. Warsh is perceived by the market as a relatively hawkish pick. The appointment strengthened the dollar, and that currency move played a crucial role in gold's decline. Here's what the data shows. A stronger U.S. dollar typically makes dollar-priced commodities, including gold, more expensive for overseas buyers. As the dollar rises, demand from non-U.S. investors can soften, putting downward pressure on prices. In this case, the firming dollar added to the selling pressure already building from profit-taking and investor caution. The impact of the sell-off was not limited to gold alone. Other precious metals also dropped sharply as investors took profits across the sector. Spot silver fell dramatically, down 14.1% to $99.79 an ounce. During the session, silver dropped as low as $95.79. This was a steep decline, especially considering that silver had hit a record high of $121.64 just one day earlier. Despite the sudden drop, silver has surged 42% over the course of the month and is still on track for its best monthly performance. The scale of both the rise and the subsequent pullback highlights just how volatile the market has become. Ross Norman, an independent analyst, noted that while a significant part of silver's rise was based on sound fundamentals, there was clearly a speculative excess within the market, and that excess is now being worked off. Platinum and palladium were not spared. Spot platinum lost 12.6%, falling to $2,298.76 an ounce. Earlier in the week, platinum had reached a record high of $2,918.80. Palladium also plunged, dropping 9.3% to $1,819.75. Across the board, precious metals experienced sharp corrections as market sentiment shifted. While futures and spot prices were falling, developments in the physical market told a slightly different story. Physical gold premiums in India rose to their highest levels in more than a decade. This increase was driven by strong investment demand ahead of a likely duty increase. In China, premiums also jumped as investment and jewelry demand picked up. These moves suggest that while paper markets were reacting quickly to currency movements and investor positioning, physical demand in key markets remained firm. This contrast between futures prices and physical premiums is important. It shows that even as prices corrected sharply, underlying demand in some regions continued to support the market. That demand, however, was not enough to prevent the immediate sell-off triggered by profit-taking, a stronger dollar, and heightened caution ahead of the Federal Reserve leadership change. Let me explain what this means in practical terms. Investors had pushed gold and other precious metals to record highs in a relatively short period. When prices move that quickly, markets become sensitive to any signal that conditions might change. The announcement of a new Federal Reserve leader perceived as hawkish was one such signal. Combined with a strengthening dollar, it created the conditions for a rapid pullback as investors reduced exposure. Ross Norman also offered a longer-term perspective within the context of this move. He said that while gold could dip far lower than current levels, he still sees a recovery and an average price of $5,375 for 2026, with a potential peak of $6,400 during the fourth quarter. These remarks came as part of his commentary on the current correction and underscore how sharply opinions can vary even during periods of extreme volatility. However, it's important to note that the immediate market reaction was driven by confirmed events and observable data. Gold had rallied strongly, investors took profits, the dollar strengthened, and prices corrected. The same pattern played out across silver, platinum, and palladium, with each metal experiencing sharp declines after recent record highs. As trading continued, the focus remained on the broader context. Gold is still heading for its biggest monthly gain in more than 4 decades. That fact alone highlights how unusual this period has been. A single day's drop, even one as dramatic as this, sits within a much larger monthly move that has reshaped the precious metals landscape. Now let's take a closer look at why this moment matters so much. The events described here touch on several key forces that drive global markets. Currency strength, central bank leadership, investor positioning, and physical demand all intersected at once. When these forces align, price movements can become extreme, as we've just seen. For investors, the sharp drop serves as a reminder of how quickly sentiment can change. Gold's rally to nearly $5,600 was followed almost immediately by a fall below $5,000. That kind of volatility underscores the importance of risk management and awareness of broader macroeconomic signals. For the broader market, the reaction to the Federal Reserve leadership announcement highlights how sensitive asset prices are to perceptions of monetary policy. The selection of Kevin Warsh, viewed as relatively hawkish, strengthened the dollar and shifted expectations. That shift, in turn, affected commodities priced in dollars, including gold and silver. For physical markets, the rise in premiums in India and China shows that demand dynamics can diverge from futures prices, at least in the short term. Strong investment and jewelry demand persisted, even as prices fell sharply on global exchanges. This divergence adds another layer of complexity to the market environment. As we move toward the close of this episode, let's recap the confirmed facts. Gold prices fell more than 8% and briefly broke below $5,000 as the dollar strengthened and investors took profits ahead of a key Federal Reserve announcement. Spot gold and U.S. futures both recorded significant losses, even as gold remained on track for its biggest monthly gain since 1982. Other precious metals, including silver, platinum, and palladium, also dropped sharply after recent record highs. Physical premiums in India and China rose, reflecting strong underlying demand. All of this is happening at once, and it's happening now. Markets are adjusting to new information, shifting expectations, and changing risk appetites. The moves are large, the reactions are fast, and the implications are significant for anyone watching precious metals and the broader financial landscape. Thanks for watching. Subscribe, share this video, and stay alert. Because what's happening right now matters more than most people realize.